Thank you, Alexandra. Good morning, good afternoon. It's really a pleasure to be here. And also invite thank you everyone to join us online to attend this session on how to close the infrastructure investment gap and the forced partnership between the public, the government, private sector, and the long-term investor to help drive the infrastructure development globally. My name is Jason Liu, head of the Global Infrastructure Facilities. For those who are not familiar with the Global Infrastructure Facilities, we are a G20 initiative started in 2015 with the sole mandate to mobilize private sector investment in infrastructure. It's a global partnership building on the support from our donors and collaborations with all the MDBs. They are our implementing agencies, and also strong network with the private sectors. Through our advisory councils, I'm glad that to see some of our advisory partners actually are presenting in this room. The sustainable infrastructure, the G20 principle of quality infrastructure investment, qualities has been the guiding principles for us. In less than 6-year operations, we have approved more than 100 projects in more than 50 countries globally. 11 projects we supported have reached closing and mobilized more than $2 billion private sector investment. And the realized mobilization ratios is almost 1 to 120 times. So one of the most effective ways to leverage the donor capital, okay? So for today's discussions, we are very lucky and fortunate to have a very powerful and a diverse panel members to join our discussions. They are the leading practitioners representing very diverse and different perspectives from public sector to private sectors, from developed economies to developing economies, okay? With that, I'd like to invite our speaker to join me, Mr. Paweł. Mr. Paweł Borys is the president of a Poland Development Fund, okay? And also I welcome our distinguished speakers to join us online, okay? Let me introduce them start from Mr. Borys, okay? Mr. Borys is the president of Poland Development Fund. He has created the first small and medium business fund in Poland and the first external index at the Warsaw Stock Exchange. He managed the pension fund for the leading Polish financial institutions, including the National Development Bank, National Bank of Poland, and the Warsaw Stock Exchange. And Mr. Enrico Giovannini, as the Minister of Sustainable Infrastructure and Mobility of Italy. He has held many prestigious positions with the government, including former Minister of Labor and Social Policies, President of the Italian National Institute of Statistics. He has been a strong advocate for sustainable development and green economies. And then Ms. Shemara Wikramanayake as the Managing Director and CEO of Macquarie Group. Before Shemara becomes the Macquarie CEO in 2018, she runs Macquarie Asset Management, which is the world's largest private manager of critical the critical infrastructure. Shemara was appointed by the UN Special Envoy for Climate Action, Michael Bloomberg, to lead the Climate Finance Leadership Initiative, CFII. This year, Shemara also leads the Glasgow Financial Alliance for Net Zero, or GFANZ, on the work stream of emerging market and the mobilization of capital. And the last but not least, Dr. Shamshad Akhtar. She is the T20 co-chair task force for infrastructure investment and financing, the first female chairperson of Pakistan Stock Exchange. Previously, she served as the Undersecretary General of the United Nations, Governor of the Central Bank of Pakistan, and the Vice President of the World Bank in charge of Middle East and North Africa. Okay. Since we have less than 45 minutes, I will start with keep the questions to 2 rounds. Ask everybody for the same questions, and please keep the answer to 3 minutes maximum. Okay. If we have a time left in the end, I would like the panelists to give us a concluding remarks in less than 1 minute. So the first question is, as we heard from the opening remarks, the private sector investment in infrastructure actually has been declining, despite multiple efforts over the last decade. The government and the international development communities has been increasingly seeking innovative approach to mobilize more private sector investment at scales. So what are the key lessons learned as you see from your own perspective? And what can you share with us in terms of the bridging the infrastructure investment gap and how to improve the partnership to help close such a gap, especially in the context of climate changes and the green recoveries? So we'll start from Shemara, then Shamshad, then Enrico, and Paweł. So Shemara, if you could share with your view from the private sector, would be great.
Thank you, Jason, and it's great to be part of this esteemed panel. Now, my views are pretty consistent with what was said on the last panel in terms of what we need to do to accelerate infrastructure investment, which is that basically we need collaboration across governments, managers of public finance and private finance, and particularly in developing countries where they're at earlier stage, the scale of investment needed is much bigger and they're having to do it during this net zero transition. So, governments particularly have this really important role to play there in terms of setting the trajectory, the policy incentives, the regulations to build confidence in a situation where private sector perceives risk to be even greater from all the feedback we get. And those policy frameworks, the stable policy frameworks, are critical, we think, to the risk-adjusted return being perceived. 3 key characteristics that have been discussed at the last panel, so at least we're consistent in our messages, is that we need a long-term approach to planning infrastructure. We need a stable and transparent regulatory framework. And then what we need is a pipeline of investments to support the commitment of long-term resource by the private sector. Now, in addition to that role by governments, the MDBs obviously have an important role to play in terms of allocating concessional finance. And if that all comes together, then the private sector has shown that it does step up and bring material capital as well as technical skills, as well as championing replication of these success stories. And we've seen it all over the world in developed countries. We've certainly had very positive experience, not just in developed, but in developing countries working with the MDBs to de-risk these early investments and build confidence and pipeline. And that's allowed us to grow the funnel of capital available to grow projects at scale. But the big feedback we're getting is that, this private sector money, it's typically the money, the savings of pensioners, retirees, nations, and it's got to focus on long-term capital protection as well as delivering income and, defensive characteristics. And so to the extent governments can catalyse investment by creating these safe environments, typically they will then bring a big flow of private investment and allow them to then exit and realise gains and recycle. So that's my 2 cents, that really more needs to be done on public and private sector collaboration to open pathways for investment.
Thank you so much, Shemara. Now we move to Shamshad.
Okay, so thank you very much for the invite. I think everything the previous speaker said was what I was going to cover, so I'm going to take another tack here. I think we all recognize that the infrastructure gaps are phenomenal. and almost 3/4 of these gaps are in the emerging markets, with about 2 trillion investment requirements in developing countries. So while risks exist in all jurisdictions, I can tell you that it is much more in emerging markets and developing countries. So one has to really think through on how to de-risk, a point which was mentioned. Now, if one were to attract funding in times right now, one has to really structure more projects that are resilient and sustainable infrastructure. We have to ensure that the infrastructure facilitates countries' implementation of SDGs and commitments to net zero emissions. And of course, there is an attempt to realign priorities and for countries to build back in response to post-COVID-19. These 3 elements are critical for the institutional investors too in today's time, or for that matter, development finance institutions, be it private or MDBs. So one of the most critical challenge is that we have to unlock private finance on a scale that is needed. And it is challenging, but it is doable because today we do have global liquidity and we have long-term institutional capital, but it requires appropriate choices, policy fixes, innovative approaches, and modalities to mobilize resources. So while there are out there several modalities, I think it's important to look at some of the new emerging cases that have come out from various surveys. One is, of course, you have to generate the pool of funds to generate the required liquidity for the infrastructure space from both the domestic and international providers. We have to alter the risk-return characteristics of investment and establish what has been called the investable asset class. So qualification is very important. Then private sector risk, of course, has to be mitigated. And that could be done through liquidity backstop, through guarantees, or through the delivered assets, or it could be used as collateral to guarantee the private financing of new infrastructure. Now, there are lots of credit enhancement mechanisms out there, both at the MDB level, and there are some local. However, some of the, a lot of the private infrastructure is finding it complex to be able to access these credit enhancement mechanisms, and there's need for flexibility there. Development of secondary markets that enhance liquidity by allowing infrastructure investment to be recycled is another important, and in developing countries, it's not emerge in a fuller context. Governments and regulators can, of course, generate liquidity by directing domestic pools of capital into infrastructure by introducing favorable regulatory frameworks, and among them is, of course, the assignment of the capital risk weights. If they are too harsh, then of course it discourages project financing. And finally, the favorable tax treatment for infrastructure. Various schemes are out there, and that helps encourage the flow of resources. Let me end here in interest of time by saying that pooling allows, of course, the financing of course, commercially unviable and yet positive socioeconomic impact projects, such as wastewater treatment plants, which is something that we all need right now in more investments in the social sector. And there is got to be more reprioritization of the infrastructure to meet the emerging demands of the COVID-19. Lots of lessons have been learned, and at the same time be prepared for the climate adaptation and mitigation in a substantive manner. And in this context, of course, the last point that I'd like to leave, which is a big subject, that we do need institutions that address the governance and capability gaps that hinder private investment. And in this context, the PPP modality and other infrastructure delivery companies, infrastructure banks, etc., can play an important role because they can do a lot of, at the start, careful structuring, and at the end, structure the financing in a conducive manner. So thank you. Over to you.
Thank you, Shamshad. Let's move on to Enrico to give us his perspective.
Thank you very much. I hope that you can hear me well. It's a great pleasure to be here with you. And in my intervention, I will focus on the 5 Ps. Maybe you know the famous prosperity, planet, people model, and so on. And I will try to build a new 5 Ps perspective. Starting exactly from perspectives, and then projects, people, procedures, and then I will unveil the 5th one at the end. First of all, let me thank the G20 for the work that has been done so far. When I took this position 7 months ago, I decided to change the name of the ministry from infrastructures and transport into sustainable infrastructures and mobility, exactly learning what the G20 had done. For a lot of people, infrastructures and sustainability is a sort of oxymoron, while the G20 work demonstrates what are the conditions to make our infrastructures sustainable. And this is indeed a very vital part of our strategy in Italy, and not only in Italy. So the first message that I would like to give to everybody, especially to developing and emerging countries, don't do the mistakes that developed countries have done for several years. We have the opportunity to make a jump towards a completely new perspective. When I was chief statistician at the OECD, we learned that developed countries around 2020, 2030 had to reinvent their infrastructures that were built after the Second World War. And we have now a big challenge of doing maintenance, but also evolutionary maintenance, because in the meantime, technology is changing. So let me focus on the first P, perspectives. The perspective we should assume is the change of our economic paradigm towards sustainability. The Sustainable Development Goals, but also the EU Green Deal and many other initiatives around the world show that we have to assume a different perspective compared to the past. We don't want to have only economic sustainability, but also social and environmental sustainability. And this implies a change of perspective. Of course, we have to assume a long-term perspective. But this long-term perspective is not only to make infrastructures that are durable, that they will last for years, but infrastructures that are built in the context, for example, of circular economy paradigm. In this way, I can shift to the second P, projects. It's not only important to decide what to do, but also how to. And in particular, in our ministry, we have issued some guidelines for any new project on railway infrastructures, road infrastructures, and so on and so forth, according to the principles laid down by the G20, circular economy, sustainability, and so on and so forth. Therefore, whoever wants to have their projects accepted has to demonstrate their contribution, for example, to the decarbonization process, and so on and so forth. So, perspectives, projects. Third, procedures. If we are not quick in developing infrastructures, we lose opportunities that technology is providing, but also we lose the capacity of mobilizing private money, private capital, because even those patient capital that institutions that we heard before want to have infrastructures done quickly and properly in a relatively short time span. Italy is not famous from the pace of our infrastructure development, and this is why we have changed in order to implement the National Plan for Recovery and Resilience, our procedures, but also the partnership with the private sector needs to be addressed. This is why one of the very first things I established as minister was a scientific commission on how to mobilize private capital funds to join the effort to change our infrastructure system. Fourth, people, very quickly, not only managers, but also researchers, scientists, because technology is evolving so quickly that in our ministry, we need to have this kind of competencies. And then people like communities. One of the principles of sustainable infrastructures laid down by the G20 is the involvement of civil society and local communities. This is a must. It has to be done quickly, it has to be done properly, but there is no way to build new infrastructures without their engagement. The last point, the last P, is again people. In this case, I'm referring to policymakers, politicians who have really to change their way of thinking, looking at new economic models, sustainable models, the 2030 agenda, or the Laudato Si encyclica by Pope Francis, but also the new economic theories that show that not only the mistakes made in the past, but also new perspectives to build a long-term sustainable development with the capacity of fighting also against inequalities. Thank you very much.
Thank you so much, Enrico, for sharing your perspective and help us expand our visions to include another P to the 3P business model we heard and the principle we heard earlier, with the perspectives and the procedures. That's indeed very important as we move forward. Paweł, can I come to you? Share your perspective, please.
Sure. Good afternoon. Thank you for the invitation for the panel. My point would be that if you would like to be really successful in promoting infrastructure investment, we shouldn't just focus on one element and trying to fix it, but we should build a comprehensive and complete ecosystem, really promoting energy transformation, digital transformation, and development of the infrastructure and cooperation between public and private sector. I believe that such a ecosystem should consist of 6 elements, 6 pillars. First, I believe there are development of the capital pillar of the pension system. The idea is that if you would like to have long-term investments, we need the long-term capital, which means long-term savings. And of course, the main sources of this long-term service are pension savings. So this is one point. The second is to have well-established, stable financial infrastructure in the country, which means, of course, stable banking sectors. As we know, in the banking sector, the prudential regulations have changed significantly after the financial crisis. It's more difficult to finance long-term projects, so we also need well-developed insurance companies, which with the asset liability management infrastructure is the very attractive asset class to invest. We need well-established financial sector, which also bring the financing, which covers the financing gap. The third point are development banks, which I believe should facilitate this cooperation between private and public sector. Not only closing some financing gap, in example, in terms of the long-term projects, but also working as a fund of funds. So I believe that the important role for development banks could be to act as an anchor investor in private funds, helping these funds to mobilize private capital in infrastructure investment. The fourth pillar would be actually the developed ecosystem of developers, operating companies. As we know, if we structure the private-public partnerships or different infrastructure investment, we need someone who have real expertise in operating the asset. If we don't have this type of companies and this type of expertise, it's very difficult to create a successful project. The fifth are, of course, regulations, which were mentioned many times, from the taxonomy to stability. As we know, it was already mentioned, public-private partnerships is extremely complex, and it should be, I fully agree, it should be simplified. The last but not least, I would call it expertise. But this is not only expertise in the financial sector, how to create an infrastructure project, but this is even more important, the expertise on the public side, how to prepare the projects, how to prepare public-private partnership project. And I think it would be that this last point could be one of the key challenge now if we have the big financing coming to really smoothly, quickly prepare of this project, because sometimes of the lack of the expertise on the central level or on the local level of the public administration.
Thank you so much, Paweł. I promise you we have a very powerful and a diverse panel. So very rich discussions and a very insightful comments and perspective. We started with Shemara give us the first-hand experience and observations from the as an asset manager from private sector, and then we heard from Shamshad the perspective from emerging markets, and then we learned from Enrico the 5 pillars, and then to Paweł the 6 pillars. We have a little bit of number competition from 5 to 6. That's great. Yeah, let's move the topic to what is more close to the reality we're facing here. Right now, the world is being hit by 2 double parallel crises, from climate change, climate crisis, to the ongoing COVID-19 pandemics. What do you have seen as the from your perspective in terms of the change of the infrastructure investment and the PPPs, and how can we make the world much better through infrastructure investment, right? And especially the collaborations between the public sectors, the government, the partnership between the long-term investor and the private sector, to use the partnership to help bridging to bring the private sector to the table. What will be the key considerations when we're facing those crises, and what will be the determined factors or the critical factors that, as we move forward to, from a private sector perspective, what will be the most critical elements to bring the private sector to the table early on? Yeah. So for this round, we'll start with Enrico first, yeah, and then Paweł, and then Shemara and Shamshad.
Thank you. I think that Europe, from this point of view, is learning quickly how to change the perspective. And let me just share with you 3 points that I think could be useful to the others. First of all, several investment funds have chosen now sustainability as an overarching framework. And this is a change compared to the past, and they're fully aware that technologies need to be implemented, for example, for sustainable mobility, but also several technological changes are needed in order to keep our infrastructures up and running in the new context. Of course, the second point is sustainability as an environmental issue. From this point of view, I think Europe is showing a great success of SDG bonds, of green bonds, social bonds, and thanks to the work of the European Commission, who decided to finance through social and green bonds the EU Next Generation Initiative, Europe will become the first emitter in terms of, for this new and very fast-running market. The third point I would like to make, again related to the Next Generation EU initiative, is the focus on outcomes, not only on money and not only on outputs. We are obliged to show results in terms of outcomes for people, for companies, for environment. So the focus is not anymore on just spending money, but the final impact. Let me just make you an example. If you have the water systems with a lot of losses, and you spend a lot of money to, let's say, close the holes, but every time you fix one hole, the pressure within the pipes increases and a new hole is created, at the end of the day, you may have spent a lot of money, even quickly, but you have not fixed the problem. And that we are not going to be paid if we do not fix the problem. And I think that what people, what companies are also expecting from governments, but also from private companies, is that we fix the problems. The climate crisis, inequalities, access to services. So I think that this is a big change in perspectives that can also help to overcome the risk of greenwashing.
Thank you so much, Enrico. Indeed, the technology changes and fixing the problems together to meet the urgent need of the services for the public is critical. Paweł, could you share your perspective, please?
Yes, so we all hope that we are after the most dangerous moment in the economy last year, with a very deep recession around the world due to COVID. And of course, the main consequence of the crisis now is the increase in the global debt. The distribution of the debt, of course, is very different across countries. There are countries in which the household sector and the corporate sector actually increased savings during the pandemic, and it is estimated that more than 7% of the global GDP represent the access savings after the pandemic. But in vast majority of countries, and this is pretty common, the public debt increased significantly. And of course, in the aftermath of the financial crisis, the answer to this challenge was to implement austerity measures to decrease debt. I believe that, of course, policymakers realized that this type of policy means often very fragile growth and not necessarily is resulting in lower debt. So now the response is completely different. The policymaker decided to implement very large investment programs around the world, financed from public resources. And maybe it would be a little bit provocative, but it would mean, in my opinion, that in the next 3 to 4 years, we will see actually that public capital, public financing will crowd out private one. And of course, with this extra low interest rate environment, the key consideration is actually to focus on more productive and efficient investment to avoid the situation that there will be a misallocation and will increase the debt further and will not have a positive effects on the productivity, on living standard. And this is the risk that next generation EU won't result in better wealth and safety nets, but it would mean the bigger debt for the next generation. And this is our responsibility to find the best project which are most productive. However, taking into consideration that Eurozone US debt to GDP is above 100%, sooner or later the policy will change and there will be more effort to decrease the level of public debt. And I believe that will be a very important moment for private capital, and the situation will change rapidly within the next few years. There will be increasing interest to involve and mobilize private capital, but we should prepare already now, inventing proper regulation and proper financing structure to have this private capital in place.
Thank you, Paweł. That's a very interesting observation as you see how the policy has shifted from the last crisis after the global financial crisis to the current crisis, and the importance of picking the projects most productive. Let me move on to Shemara to share her perspective from the private sector asset manager side.
Well, thanks very much, Jason. And you asked about the impact of two crises, the COVID one and the climate one. And the COVID one, as you were just observing, was very different to the things like the global financial crisis, because it was actually not a financial crisis, but a health pandemic that required economies to be completely shut, but for a very short time and then open up. And so in terms of impact on infrastructure assets, I'll comment on the three main classes, but it was not as permanent an impact because of the quick reopening. But as Paweł just said, the big impact really was that we've come out of this with a lot more fiscal debt. And, we had monetary and fiscal stimulus, which was critical in the shutdown. I sincerely hope that it's not going to be the case that the public purse feels now that it has to take on more of the traditional infrastructure funding, because frankly, with the economies having opened up, if I look at the three main classes of infrastructure, utilities, which is electricity, gas, water, the private sector should be positioned to keep investing in that because they're defensive assets, they're essential use. We didn't see the demand impacted materially at all. It was marginally in shutdowns, and it proved what resilient assets they are for long-term private savings to invest in. In transportation assets, we saw roads as well, short, sharp shock, opened up again, traffic coming back, growing with GDP as they usually do. Interestingly, ports that are very impacted by GDP actually had very strong volume during the shutdown because people were investing in goods and spending on them a lot more because they were able to shop online and learn online and all of that. But air travel was, of course, severely hit, particularly international, and domestics coming back. IATA says probably 2023 by the time international comes back. And then the last class of infrastructure, there's utilities, transportation, communications infrastructures, the other big class we invest in. And there we've actually seen a surge in demand for digital infrastructure. So tons of capital needed in the private sector responding, whether it's in data centers, hyperscale data centers, towers, fiber optic networks. We just invested in open fiber with CDP there in Italy. We invested in Autostrada per l'Italia with CDP and Blackstone. So I'm hoping we, the private sector, that are awash with capital, infra funds with a lot of dry powder, will step up and do the traditional infra post-COVID in the regions that are de-risked and not draw on the public purse. The climate challenge, though, is a different one because people are having to put money into new infrastructure there where there's more risk, and we really do need to partner with the public sector there. So be it in mitigation strategies in areas like, say, energy. I mean, wind and solar now are becoming scaled and the costs are coming down, but we need grid infrastructure for firming there. We need things like hydrogen to be developed. We need batteries for storage. We need electrification of mobility. We need precision farming in agriculture and technologies. I think that's where, where there's high risk early on, the public sector could use its money effectively. And then the other big thing we need from the climate crisis is investment in, as was discussed in the last panel, resilience, adaptation, because we're finding more extreme weather events, and we're finding we're having to do things like bury power lines underground in Finland to survive very cold, harsh winters, lift bridges in New York because of rising sea levels, put in geothermal geohazard warnings in assets we have in the Philippines. There, I think potentially the private sector should be able to invest because it makes the asset more resilient and there's commercial financial return. So it's principally in that mitigation area and partly in adaptation where I think the public sector needs to catalyse that private sector money, as we've been discussing. So I'll leave it there, Jason, because I'm keen to hear from Shamshad on this as well, and the others on any other questions. Thank you.
Excellent. I like the positive tone and the long-term review. You see this instead of a crisis, you see a lot of more opportunities for the private sector, both in terms of the current crisis, but also in the climate change agenda as well. Excellent. Yes, indeed. Let's move on to Shamshad to hear her perspective from the emerging market side. Shamshad, please.
Yes. So thank you very much. Very good presentations thus far. I think I'd like to make really more in detail 2 points rather than go over everything. And it starts from the standpoint that, we had a financial crisis, then we had pandemic, and now we are in midst of what I believe a debt crisis, and we have to prepare ourselves simultaneously for the more ravaging effects of the climate. We think pandemic was bad. I think from all indications, climate change will have a disastrous effect. So obviously preparing infrastructure effectively is very important, but if we are to invest more into infrastructure, I think we have to deal, and G20 has attempted to do, with the debt crisis. And G20 debt deal, I think, falls short on several counts. And if it continues that way, I think in the emerging markets and developing countries, getting a major enhancement of infrastructure would be quite difficult. G20 approved the debt service moratorium, but its coverage of debtors and creditors is very limited, and the liquidity support that was given was confined to 40 low-income countries. It excludes the middle-income countries, and there is no effective mechanism for private sector debt resolution. So what do we do with the debt, which was high pre-pandemic? And I'm talking about the sovereign debt, as you will appreciate. And then pandemic has resulted in further build-up, including that from the multilaterals because of the liquidity support. Now, of course, there was huge fiscal multipliers of public investment and monetary stimulus. Now, fiscal multipliers of public investment, as we know, are higher than for other types of public spending, about 0.8 in first year and 1.5 within 2.5 years. And if it is on the base of contractionary phenomena, then it's still higher. So one was hoping that the fiscal multipliers and the MDB's funding would have gone into infrastructure. I can tell you from the South Asian scene, which I'm more closely watching, it hasn't happened because everybody used the stimulus of the MDBs and fiscal stimulus to rescue people. So money is an issue, and that needs to be sorted out with the pending debt problems. Now, the second point that I'd like to make is regarding what we have talked about in the T20. I mean, the T20 was a very enriching process, and there's a huge amount of recommendations there for G20. But one paper that I personally worked on was that Of course, we have to work on climate issues, and I zeroed in on the climate neutrality, or what we call the net zero emission, to go beyond the federal to the subnational governments, including the cities. And that, as you will appreciate, is because of a variety of reasons. The cities contribute and the subnational governments basically contribute a huge amount of the GH, and they contribute 50% of the global GDP, and they are half of the carbon emissions. So how do you move on that front? And as I was analyzing, it's a very difficult one, and you can't get to net zero emissions at country level without tackling the issue of the subnational governments and municipalities. So it requires a coordinated and synchronized action across the central and subnational governments. I think it's high time that the federal legal frameworks and commitments are cascaded down to the subnational governments, and we need dual response, one from the federation itself and the other from the multilateral community. On the domestic level, I think that it's high time that the fiscal frameworks of devolution are revised. Now, I know it's a constitutional issue, but they need to be revised because they are distributed on the basis of population growth that contributes to the greenhouse emissions. So, and also other things that are not very constructive. So it would be useful if there was much more debate on the subnational governments, net zero emission. How do you really position on that front? And also within that context, my last point, because of the time issue, time constraint, that it's important that we really look at how do you really tackle the whole issue of the credit enhancement, which is very critical for the developing countries. And I stop here because that's a big subject to itself, and that has been addressed in the brief. We have gone at length to explain. There are lots of other interesting infrastructure investment and sustainable finance briefs. In interest of time, I will stop here, but if there's time, I'm happy to give the little snippets on that. And I want to thank the Italian G20 chair and the chair of the Think 20, because it was very competently managed this whole process, giving us a whole range of ideas. So there's paper on, of course, ecosystem, the nature and all other things which have been taken to the next height of discussion. Over to you all.
Thanks so much, Shamshad, for sharing your perspective from developing countries, emerging market perspective, and also from the T20 side. Thank you also for reminding us bring up the issues on the debt and the fiscal stimulus in our response to the current pandemic crisis, and also the important role of subnational government and the credit enhancement tools in tackling the climate change issues. I'm sorry that we're running out of time now. It's such a big topic and a very exciting topic as well. We can spend the entire day to continue to debate on this. I want to thank our panelists for this very rich discussions and sharing their insights with us. Let's give them a round of applause, and also thank all the audience for your participations. Thank you. So with that, I'm going to hand the floor back to Alexandra.
Thank you. And thank you, Jason, and all your panelists for this truly global perspective.